So good afternoon, everyone, and a warm welcome to the webinar today entitled My Financial Savings and Investments Matter, Making Sense of Investment Taxes, which is the final part in our Savings and Investments webinar series. And today's webinar is brought to you by us here at My Money Matters, working in conjunction with your employer. So as you can see on the screen there, my name's Nick Pottinger, and I'm one of the financial education coaches here at My Money Matters. And I've worked in financial services for well over 20 years now. And during that time, I've helped thousands of people like yourselves to gain a better understanding of their finances and make a true difference to their overall financial well-being. Few bits and pieces to cover before we get underway today then. So the content of this webinar is provided for educational purposes only and does not constitute financial advice. And the information given is based on our current understanding of taxation legislation and regulations. Any levels and bases of and reliefs from taxation are subject to change, and tax treatment is based on individual circumstances and may be subject to change in the future. And the value of your investments and an income from them may go down, and you may not get back the original amount invested. And please seek the relevant professional advice, as taxation can be a complex matter, and this webinar may be recorded for training and compliance purposes. So today's webinar being hosted on the Microsoft Teams platform. You do have the opportunity to ask questions as we go through today's session. So in order to do that, all you would need to do is click on the speech bubble at the top of the screen, which can usually be found in the top right-hand portion of your screen. Once you've clicked on that, you'll then be able to type your questions in. And at the end of today's webinar, I'll be going into that Q&A box to firstly pull any questions across to public view so everyone can see them. And I'll also answer as many of your questions as I possibly can. And before we get stuck into today's topic then, what I just want to talk around is the fact that you may already be aware we've got a vast number of different webinars available on the My Money Matters platform, covering topics such as debt and money management, savings and investments, estate planning, insurance and protection, and finally retirement planning. So please do consider what the important financial subjects are for you and book onto any of those webinars at a convenient time and a date for yourself. But moving on to today's webinar then, and what we're covering. So as I mentioned at the beginning of today's webinar, this is the final part in the savings and investments box set, where in part one, we looked at the importance of setting financial goals. And part two, we looked at understanding the true return on your savings and investments. We then looked at creating the right strategy and building the perfect portfolio in parts 3 and 4, which leaves us with the final part in the series to cover today, where we're looking at breaking down and making sense of investment taxes. So today we're going to be looking at the various limits the government allow you to earn from your savings and investments before you incur taxation. So specifically, I'll talk you through the personal savings allowance before moving on to investment taxation. And then importantly, I'll show you what you can do to help your money grow as tax efficiently as possible. Okay, so to start today off then, let's just talk around firstly the personal savings allowance. So the personal savings allowance, often abbreviated to PSA, is the allowance set by the government and is essentially the amount of interest you're allowed to earn on your savings within the tax year without needing to pay tax on the interest that you're accruing. And when we talk about interest being earned, I would imagine that most of you would probably automatically think of that meaning a personal savings account being applicable on something like a bank account or a building society account. But actually, it includes many other financial products and services too. So the PSA also covers savings and credit union accounts, unit trusts, investment trusts and OICs, which are commonly professionally managed investment funds or pooled funds between its members. Covers peer-to-peer lending, and that's where you agree to lend your money to various people looking for credit for a set period of time for a return on your money. PSA also applies to things like trust funds, payment protection insurance, government and corporate bonds, and lastly, life annuity payments. So the PSA is an allowance that's applicable to many different financial products, not just your typical savings account. So just be careful if you have got money saved in other types of arrangements. as you could be using up more of your personal savings allowance than you might originally expect. Okay, so those are the types of products your personal savings allowance can apply against. Let's now just move on to talking around what the actual amount the personal savings allowance is and what taxes you may be due to pay. So the first thing to point out with the personal savings allowance is, although the tax systems vary from country to country in the UK, your personal savings allowance will be based on the English tax system. So even if you're a resident of Scotland, what you would have as a personal savings allowance will depend on where your total income falls within the tax year based on the English tax system. So if your income is within £12,570, you would be paying no income tax, as that's the amount you're allowed to earn within the tax year before you're due to pay tax, which is called the personal allowance. Then any income earned in the tax year between £12,571 up to £50,270, you would have that segment of your income in the 20% bracket. You'd be coming into the higher 40% tax bracket for income earned between £50,271 up to £125,140. And then the last tax bracket you might fall into, if you're earning enough, is the 45% additional rate tax bracket for any income earned above £125,141 within the tax year. So looking at those various tax brackets and where your total income falls within the tax year will determine what your personal savings allowance is for the tax year. So if your total income is within the basic rate tax bracket, you will have the full personal savings allowance of £1,000, where you're allowed to earn up to £1,000 in interest before you're due to pay tax on anything above. And if you're a non-taxpayer, you would have a savers starter rate of £5,000 and the £1,000 personal savings allowance on top of that too, where you could effectively be earning a total of £18,570 from your savings interest, tax-free, once you add the personal allowance of £12,570, once that's added into the equation, and assuming that you're not earning any income elsewhere. Now, if your income within the tax year takes you into the higher rate, the 40% tax bracket, your personal savings allowance will be reduced to £500. And for those of you fortunate enough, or unfortunate enough in this case, to have earnings above £125,141, that's where your personal savings allowance would actually completely disappear, meaning any gain you're making on things like your savings would all be taxable. And in terms of the tax you would be due to pay if the interest you earned went above your personal savings allowance, so if your total income in the tax year, including your savings interest, is within the basic rate tax band, you would pay 20% tax on your interest earned above £1,000 within the tax year. If you're in the higher rate tax bracket and therefore have a reduced personal allowance of £500, personal savings allowance that is of £500, any interest you earn above £500 would be taxable at 40%. And then if you're in the 45% additional rate tax bracket, without any personal savings allowance there, any interest you earn would be any interest you're earning on your savings would be all taxed at 45%. So that's the personal savings allowance. So now you should know what your personal savings allowance is and what taxes you're due to pay if you go above it. But let's now move on to savings taxation, move away from savings taxation, I should say, and look at what taxation you would incur on your investments. So if you've got investments, unfortunately, the personal savings allowance does not apply to these types of earnings. And instead, investments are going to be subject to various other forms of taxation, depending on the type of investments you hold. And this could be taxation like stamp duty, it could be taxation like capital gains tax or dividends tax. So let's just start with the first on this list then, which is stamp duty. So when a lot of people think about stamp duty, their mind will automatically go to property, as stamp duty is a well-known tax within that sector. And stamp duty tax could be payable when purchasing a property, whether for residential or investment purposes. But today we're going to be mainly focusing on stamp duty payable when purchasing shares. So if you want to find out more about stamp duty when purchasing property, please do sign up and join up to the My Mortgage Matters webinars to find out more details on property stamp duty there. So today's webinar focusing specifically on savings and investments. We are just focusing really on looking at stamp duty payable on share ownership. So when you purchase shares, you will usually have to pay something called stamp duty reserve tax, which is paid on the total price paid for the shares bought electronically via CREST, which is an acronym for Certificateless Registry for Electronic Share Transfer. And with the stamp duty tax payable on share purchases, you would pay 0.5% stamp duty based on the full amount paid for the shares. So, for example, if you purchased £100 worth of shares, you would pay 50p stamp duty due to that levy there. Now, there can be some exceptions to the stamp duty tax payable on share purchases, so it would not apply on new share issues or OICs or unit trusts or the AIM market, but in all other cases, it would be payable. So stamp duty then is the tax that you have to pay to essentially gain entry to the UK share market, and it's not the end of the matter when it comes to taxation on investments either, because when it comes to when you sell those shares, you may get hit with another form of taxation as well, which is capital gains tax. And this is a tax that's generally charged on the disposal of certain asset types and investments, including company shares. Now, similar to the personal savings allowance, the government do allow you to make a certain amount of gain within the tax year before you have to pay capital gains tax, which is called the annual individual exemption. And for the 2024-2025 tax year, it's £3,000, which has actually come down quite a bit over the recent years. As up to 2022, the annual individual exemption was actually £12,300 at that point. But the government have been reducing the exempted amount quite drastically over the last couple of years. And many people do refer to this as a bit of a stealth tax. So you can make a £3,000 gain then within the tax year before you're due to pay capital gains tax. And the good news is that for those of you who are married, if you can effectively try to mitigate going above the exempted amount to a certain degree by making use of a spouse transfer, where you could transfer the ownership of your shares to your spouse before they're sold, and you could then have up to a £3,000 gain on the transferred shares before they are due to pay capital gains tax. So if you're married, with some careful planning, you could potentially make a gain of £6,000 within the tax year and not have to pay capital gains tax by making use of that spousal transfer. But in terms of the tax calculation for capital gains tax, the tax is calculated on the gain above the annual exemption after costs are deducted, such as fees, stamp duty reserve tax, and taking into account any previously reported losses, where as long as those losses are reported within 4 years from the end of the tax year that the loss was made, any previous losses you've made on your investments can be used to reduce or offset that year's capital gains tax or carried over indefinitely. So importantly then, how much is capital gains tax going to cost you if you go above this £3,000 annual exemption amount? Well, it does work on a sliding scale. So for those of you here today in the basic rate tax band, your gain above £3,000 would be taxable at 10%, or at the higher 18% if you've made a gain, if you're disclosing a gain on a second property. And for those of you in the higher and additional rate tax bands, your gain above £3,000 would be taxable at 20%, or at 24% if the gain was made from a second property. And in terms of reporting the gain to HMRC, usually made by self-assessment, you would need to make sure that you do that within 60 days of the disposal of the second property. So quite tight deadlines there for reporting when it comes to property investment gains. But if you do have perhaps a bit more time to report back to HMRC for other gains made outside of additional property, where you've got until the following 31st of December from the tax year that you made the gain to report it to HMRC. Okay, so let's now take a look at an example then of what capital gains tax might mean for you and how you'd go about working out the amount payable. So firstly, as I mentioned a couple of slides back, if you do have a spouse and they're not using some or all of their capital gains exempted allowance for the tax year, try and take advantage of that, where you could potentially save yourself paying capital gains tax on up to a further £3,000 of gain that you've made within the tax year. Although in order to take advantage of that, you must have a spouse and be living together at the same address. So the first step then to work out what capital gains tax you're due to pay is to work out your monetary gain. So in this example, let's say this person has made a £20,000 gain on the disposal of shares within the tax year. What you're then allowed to do with that gain is deduct any costs incurred from the total gain made. So in this example, let's say there were £2,000 of costs, which can be deducted from the overall gain. And in this example, the person unfortunately had no unused losses they could further offset the gain against. So they have their £3,000 exempted amount and £2,000 in costs that they can deduct from the £20,000 total gain, leaving the remaining amount of gain at £15,000. And also we're working on the assumption their spouse has no spare annual exemption amount to potentially transfer some of the gain to. So in this case, it would be £15,000 of the gain made, which is taxable. And assuming that they're a basic rate, 20% basic rate taxpayer, they would need to pay capital gains tax at 10%, which would mean the capital gains tax charge would be £1,500 in this instance, 10% of 15,000. So that's capital gains tax, the tax on the gain made on the disposal of an investment asset. Now let's talk around another form of shared investment taxation, which is dividend tax. So if you own shares, you may well be getting a dividend in the form of from the share that you own, which is usually paid twice a year. And it's where you're effectively being incentivized to keep holding the shares in the form of regular reward payments, which are known as dividends. And it's essentially where the company is sharing their success with you. And you are allowed to earn a certain amount within the tax year from dividends before you're due to be taxed, which is currently £500 per annum. So whatever tax bracket you happen to find yourself in, everyone will have this £500 dividend allowance. But again, similar to capital gains tax allowance, this dividend allowance has been drastically cut over recent years, where in the 2021-2022 tax year, the dividend allowance was £6,000. So this is why it's so important to keep informed of the latest rules on taxation, as by not doing so, you could end up landing yourself with a hefty tax bill that you might not otherwise have been expecting. So the tax band that you're in will determine what level of tax you're due to pay on your received dividends over and above that £500 per annum allowance. So if you're a basic rate taxpayer, you would need to pay 8.75%. As a higher rate taxpayer, you would be hit with a 33.75% charge on any dividends above that £500 allowance. And as an additional rate taxpayer, you would have a 39.95% dividend tax charge, again, on any dividends received over the tax year above that £500 personal allowance. So let's take a look at a working example then of dividend tax, just to try and break it down and make it a little bit easier to understand. So let's say you were earning a salary of £70,000 and you're lucky enough to receive a total of £5,000 in dividend payments from the shares that you own within the tax year. So as we know, you've got the £500 dividend allowance. So that would mean that you've got a total of £4,500 of the £5,000 earned from dividends that would be taxable. And in this example, as your salary is £70,000, you would be in the higher rate tax bracket and would therefore need to pay 33.75% on the £4,500, which would mean that you would face a tax charge in this instance of £1,518.75 on the dividends that you would have earned in the tax year. So that's how you would work out the amount of tax you're due to pay on your dividends. But how would you go about actually paying that tax? So the good news is, if your total dividend payment within the tax year is below £10,000, you don't necessarily have to complete a self-assessment, as you will have the option of simply contacting HMRC to amend your tax code, so they can then take what you owe from your salary in the form of increased taxes by reducing your £12,570 personal allowance. Although you do have the option of completing a self-assessment if you so wish to do so. However, if your dividend payouts totaled to more than £10,000 within the tax year, you will have no other option but to complete a self-assessment form. So do bear that in mind, essentially, to ensure that you are following the correct reporting procedure to HMRC for any dividend tax that you're due to pay. So in summary today then, whether you're saving or investing, you do have some choppy waters to potentially navigate when it comes to the taxes you're due to pay. So with savings tax, remember you're allowed to earn up to £1,000 in interest as a basic rate taxpayer, or up to £500 as a higher rate taxpayer. But if you're in an additional rate tax bracket, you would actually have no personal savings allowance to work against. And with stamp duty on shares, you pay 0.5% stamp duty reserve tax on the purchase price of the shares that you purchase. And any gain that you make over £3,000 within the tax year on the disposal of investment assets is liable to capital gains tax. And with dividends tax, everyone can earn up to £500 in dividends per tax year, tax-free. But after that, you would pay tax at the rate you're due to pay, depending on the tax bracket that you find yourself in. So what are your options then when it comes to in terms of what you can do to try and get your money working as hard for you as possible and as tax efficiently as possible too? So firstly, make sure that you're using the government approved allowances to maximum effect, whether that's using the personal savings allowance, the £3,000 capital gains tax exemption, or the £500 dividend allowance. And if you're going to be making more than those allowances provide within the tax year, well, that's where you'll probably want to explore other options at your disposal. So other options that you have is you could invest between £25 up to £50,000 into premium bonds. And the good news is that any wins you receive from premium bonds are all tax exempt. And the current prize fund rate for premium bonds is a respectable 4.4%. But just remember that you're not guaranteed that rate, as it just effectively means the average. It doesn't mean that the average payout. All that's really essentially meaning that 4.4% is that they're paying out 4.4% on every £100 in terms of prizes that are paid out via premium bonds. So you could be achieving a rate quite a bit lower, essentially, than 4.4%, even if you had average luck. Or you may achieve a payout far greater than that. So if you're lucky enough to manage to bag the £1 million prize, which by the way, the odds of winning that £1 million prize currently sit at 49,563,000 if you had £100 invested into premium bonds. So quite a low chance of winning that prize, but there is a chance all the same. And another fantastic way of building your wealth and limiting your tax exposure at the same time is by saving into the local government shared cost AVC, which is exclusively available to you as LGPS members, where you obtain some fantastic tax breaks as the money goes into the arrangement on your income tax and national insurance savings. And then potentially you can take the whole pot of money you've built up within the AVC arrangement all back as a tax-free lump sum when you take your AVC at the same time as you take your main local government pension, and as long as your AVC pot is within your personal upper limit. And we do have a host of webinars that go into more detail about how you can use the local government shared cost AVC to your advantage, building wealth for your retirement on the My Money Matters platform. So get yourself booked onto one of those dedicated shared cost AVC webinars if you haven't already done so, to learn more about that. And also harking back to the previous webinar in the savings and investment series, which was all about how to create the perfect portfolio by using your £20,000 yearly ISA allowance to maximum effect. where we went into detail about what types of assets you could be looking to invest in based on your attitude to risk and taking into account other personal factors too. But generally speaking, you can build up your investment portfolio within an ISA to fit your specific needs, where you could have some money in cash assets for easy access. You could be investing into bonds to generate regular additional income. And you could also be investing into equities, which most people know as company shares, for growth and building overall wealth. Because within an ISA wrapper, all your savings and investments are completely tax-free. And therefore, it's a great way of allowing you to keep more of your hard-earned money in your pocket due to being completely shielded from most of the taxation rules that we've talked about today. So do strongly consider an ISA arrangement if possible when planning out your savings and investments goals. So today marks the end then of the savings and investments box set, where we've covered everything from looking at financial goals and understanding what you would need to do to budget for your intended savings targets, to understanding the true return, where we looked at the negative impact of inflation on your savings and investments. We then looked at creating the right strategy and building the perfect portfolio, where we went into detail about the different types of asset types you can invest into and what might be right for you based on your savings needs. And then finally, with today's webinar, we've had a look at the potential impact the various forms of government taxation could have on your savings and investments portfolio. So what I would say then is, if you missed out on attending any of those previous savings and investments webinars, not to worry, because there are plenty more spaces available at future dates. So just log into the My Money Matters platform to book your place on any of those webinars now. So in terms of next steps then for after today, so do have a look on the government website, www.gov.uk, where you'll find more information about what we've covered today in terms of the various forms of taxation you may incur on your savings and investments. And why also not have a look at an application you can download to your smart device called Snoop, as it provides a great tool in terms of getting your budgeting under control by using something called open banking to help understand what you're currently spending out on, helping you potentially save money that you could then invest. And not only that, it also searches the market for the best deals in relation to where you could be saving and investing and getting the best bang for your buck. So do have a look at Snoop. Just log into your account on your My Money Matters platform, click on the Snoop tile at the bottom of the homepage to get a QR code there. And once that's scanned in to your smart device, that will then take you to the Snoop application. So please do have a look at that as well. And as I mentioned at the beginning of today's webinar, please do have a look at all the other webinars we host and all the other important financial matters too, from taking out your first mortgage to planning for your retirement. All the webinars are there for you on the My Money Matters platform. And talking about planning for your retirement, please do not forget that you do have access to the local government shared cost ABC arrangement. It's exclusively available to you all being LGPS members, and you can gain access to that product via the My Money Matters platform. Log into your account and you'll see the shared cost ABC tile on the homepage for more details on that. And the shared cost ABC just offers a fantastic way to help boost your wealth in retirement. Okay, so in terms of getting in contact with us here at My Money Matters, so we've got the main website address on the screen there, my-money-matters.co.uk. If you would like to see new content on the platform, perhaps something that you can't see on there already, or have perhaps seen a latest news headline and you wonder how that could impact your finances going forward, do send your suggestions in to us at suggestions@my-money-matters.co.uk. And in terms of getting in contact with our customer services department, a couple of ways of doing that. You can simply email us at support@my-money-matters.co.uk, or you can give us a call on that telephone number at the bottom of the screen there. We're typically open between 8:30 AM to 5:30 PM weekdays. Okay, right, well, let's see if we've had any questions. So Andy's asked, what is the personal upper limit for pensions currently? So, yeah, I mean, that's something we haven't covered today because we were looking at taxes outside of pensions, really. But ultimately, with pensions, you've got something called the annual allowance in relation to your pension.
And it used to be, for quite a number of years, £40,000, the amount that you're allowed to put into pensions in a tax year and get tax relief on. But last tax year, it got increased to £60,000, and it's the same this tax year as well. So it's £60,000 that effectively you're allowed to pay into pensions within the tax year and get tax relief on as the money goes into your pension. Now, just because the annual allowance is £60,000 doesn't mean that you can pay £60,000 into pensions and get tax relief on that in the tax year, because you have to actually be earning enough to be due paying tax on £60,000 of your income within the tax year. But if you're in that position, potentially you go up to £60,000, maybe even more than that as well, because what HMRC do allow you to do is look back into the 3 previous tax years, and any unused annual allowance that you haven't used in any of those 3 previous tax years can actually be carried forward into the tax year you're currently in. So let's say, you know, you ended up paying, I don't know, £65,000 into pensions in a tax year, £5,000 over the standard annual allowance limit. Well, it wouldn't necessarily mean that you would face a tax charge on that £5,000 to pay the tax back that you received, that they would say that you shouldn't have perhaps received, because if you've got £5,000 of unused annual allowance in any of those 3 previous tax years, you could carry that forward and effectively pay more than that £60,000 into pensions in a tax year. But yeah, the annual allowance, generally speaking, standard annual allowance, £60,000. I suppose the only other exception to that would be if you triggered what's called the money purchase annual allowance, and that's where HMRC put kind of further restrictions on what you're allowed to pay into pensions going forward. Now, you would trigger the money purchase annual allowance in kind of specific scenarios. So first of all, you'd have to be over the minimum retirement age, because in order to trigger this scenario, you have to access money from a pension. So you have to be over the minimum retirement age to do that. That's currently age 55. And if you accessed money from a money purchase pension in a certain way, typically by taking a kind of chunk of it as a lump sum, some of which you end up paying tax on, that's where you'd trigger the money purchase annual allowance limit, where HMRC would put further restrictions on what you're allowed to pay into money purchase pensions going forward. That's not your main local government pension, by the way. Your main local government pension is not a money purchase pension. It's a defined benefit pension. But a money purchase pension could be things like the local government shared cost ABC. And currently, if you trigger that money purchase annual allowance limit by accessing money from a pension in a certain way, you would have a limit of £10,000 that you'd be allowed to pay into money purchase pensions going forward in the tax year and allowed to receive tax relief on. Wynn's asked, what choices are available as to where the ABC is invested? Are American ETFs an option? Unfortunately not. So in terms of the money you can put into an ABC, you can't invest into ETFs, which are exchange traded funds. But you've got the kind of traditional pension funds you're able to invest in. What funds you've got available to you will depend on who your actual ABC fund provider is, because there are a few of them. You could have Prudential as your ABC fund provider. It could be Standard Life or Legal and General or Clerical Medical. Your local government pension fund would have chosen who your particular ABC fund provider is. And all of those providers will have their own range of funds, typically kind of grouped into different risk categories, where you're kind of be looking at kind of minimal risk funds, medium risk funds, higher risk funds, for example. And the further up that risk scale you go, the more potential there is to see greater growth. But of course, there is more potential to see greater loss too. Not all the funds would be investing into things like company shares. Often people think, well, if I'm going into a pension, I'm going to be investing into company shares. Not always the case. Yes, the funds in the kind of higher risk and medium to higher risk categories, and some of the medium risk as well, may be investing either all into company shares or partly into company shares. When you're kind of looking at some of the medium risk or lower to medium risk funds, there'll be funds that are maybe just purely investing into government gilts, loans to the UK government, or corporate bonds, which are loans to companies. And when you're getting right into the kind of bottom end of the risk scale, you'll be looking at funds there just purely investing into money market instruments. So you do have a range of funds you're able to choose from, and you would choose those funds based on what your attitude to risk is and what asset types you want to invest into. But to answer your question again there, when in terms of ETFs, unfortunately, you cannot invest into ETFs within the shared cost ABC arrangement currently.
Okay, I think that might be it for questions today then. So what we'll do is we'll get today's webinar wrapped up for you in that case. So I hope today has left you with a more informed position, essentially, on the types of taxation you might incur on your savings and investments in various situations. So always do try to remember to make the most of your savings and investments allowances. And if you're going to go above those allowances, that's where you may want to look at other ways to save and invest your money, where if you're happy to tie your money up to later on in your life, a local government shared cost ABC could be the way to go there. And you've got that £20,000 ISA allowance each year too, where any money held in those types of arrangements, the shared cost ABC or the ISA, will be free of any interest tax, capital gains tax and dividends tax that we've talked about today. So I hope you found today useful, everyone. I'll let you get off now, and I wish you a great rest of the afternoon. Many thanks.